Today, we have an episode with Matt Bontrager, who has all sorts of tax expertise that we're going to dive into, particularly around short-term rentals.
It's astronomical to me to see how many CPAs and accountants out there that just do not understand real estate taxation. We are real estate accountants to help utilize real estate to bring down people's taxes. If I have somebody making a $100,000 W-2 that's at Meta or they're a nurse, you're talking about completely offsetting that person's income with no tax bill.
Matt, thank you for joining us today.
Thanks, Vince. I'm pumped to be here.
My pleasure. So you grew up in Las Vegas and you went to UNLV. Can you kind of take us through what life looked like, in your childhood leading up to college? And then what did you study at UNLV and what were things like for you in college?
Yeah, life leading up to college, I would say, is pretty normal. When I think about money, though, as a money guy, I am a CPA. There's my license. So I do think about money a lot. Didn't grow up rich, didn't grow up poor, but I would say closer to the lesser income as far as a household goes. Went to public school. Once I got to college, I tried to play a sport. That sport was baseball. That didn't work. So I was like, okay, I need to get a good degree. And then given that I was interested in money, I had a job at the bank. I worked at Wells Fargo and I really liked that. I liked how that was going. So then I went into accounting. So I started to get an accounting degree and then I finished that, left school and started at Deloitte. In school, they really preached to you got to go to the big four. So that was what I worked hard to do and I did.
Did you feel like you were motivated by money based on how you grew up? What kind of role did that play for you psychologically?
Yes, I was motivated by money, but when I start to think that I couldn't take any action on that until I was, I'm 34 now. I turned 35 in 2 days, or I'm sorry, 34 in 2 days and 33.
Happy early birthday.
Thank you. I started this business 6 years ago. So I would say up until I was a business owner, I didn't really I don't feel comfortable saying that I was motivated by money because I don't know how much of the decision making that I did was motivated by the outcome of money. It was very risk adverse. So it was go to school, get a degree, did that. Go to the big four, did that. When I left the big four, great resume builder. Everywhere I wanted to go was willing to give me a job because I had that on my resume. So it was really just trying to stay risk adverse and look really good on paper. It wasn't until 2019 when I had left the W-2 to start my own firm in 2020 that I would say that was the first really money motivator. Because at that point I knew that it was, it could be proportionate as far as how much money I could make.
Got it. What kind of foundational things do you feel like you learned at Deloitte that served you to go and be an entrepreneur and actually start your own business working for yourself?
So first, I think corporate structure as far as interacting with other employees within a business. So if it was staff that I had to work with and how to understand what their roles are, how to communicate with them to get projects done. And on the flip side, hire and leadership. I really enjoy that. Running a business now, I still, even in my own business, feel these small mom and pop style, circumstances that happen where it kind of annoys you at times because you're like, man, I thought we were a bigger business than this. But it also just sets the perspective of business. There's so many things to worry about. Sometimes something's going to feel like you put it together with duct tape. Sometimes it's going to feel like you took 6 weeks to plan it. And so I think having the experience of coming from Deloitte and understanding the professionalism, how much money these people are making, how big their engagements were, I like having a taste of that because now I can understand how to implement that in my own business. I would have felt, I think, very lost without that Big Four experience.
Was there a moment when you knew that you didn't want to stay in the Big Four or that you felt that you were destined for a more entrepreneurial path?
No. And that's I answer that very strongly because as a kid, I make the joke, I was not an entrepreneur. So I wasn't slinging candy bars out of my backpack at lunchtime. I wasn't, lemonade standing and, selling things as a kid. It wasn't until I left Deloitte. I stayed at other public accounting firms because what I think is very important to mention in accounting is when you go into accounting, you're choosing public accounting or you're choosing private. Private being you're working for one firm and that you just work for that one client. So I'm in Vegas. A lot of us go to work at the casinos. So it's like me going to Caesars or MGM and sitting in their back accounting office doing accounting all day for them. Versus public accounting, I'm working with a variety of clients. I'm growing a book of business and I'm hiring and firing clients. So I really enjoy the variety. And when I left Deloitte, which is also public accounting, I stayed in public accounting because I liked that side of the business. And it was quickly that I started to understand that I could land these small jobs on my own. I would do someone's taxes for $300. I would land another return at $800, $1,000. So it's a very easy profession to moonlight in. And once I probably had 40 to 50 grand worth of accounting work, of tax work, there was one flipper here in Vegas. He was probably one of the largest flippers at the time. And he had posted on Instagram that he needed a bookkeeper. So I wrote him, I'm like, oh, dude, I could do this with my eyes closed. Landed him at like $2,200 a month. Take that with the 50 grand that I had made a joke to him like, hey, we should start a firm together. You drive all the work. I'll do all the work. And that's what we did. And I started it in 2020. I quit my job in December of 2019. And so to me, it was I had this big lily pad that I knew I could jump on and float for a minute. I wasn't sinking immediately, which is always what would you do if you were starting a business? I would build a runway. And again, as a risk adverse guy, I need some cushion. I need to know that this was thought out and had I'm not, jumping and building the plane kind of thing. That wasn't me.
So you said that you'd partner and that you would do the work. What was involved in that? What did you have to do?
So in this partnership, it was a beautiful partnership when it started. I recently bought him out in 2023, but the deal was he had the exposure, the online content. He was an avatar of the client we were going after. So he'll go out, he'll spray the name around, he'll talk about TrueBooks, talked about he owned a piece of the firm and he drove the clients and then I ran the firm. So I did all the work myself for about the first year, then quickly had to hire staff and build out the systems. And so, we're on year 6 now. So it's felt like 20, but yeah, we're 6 years in.
That's really interesting. I'm really excited to start to get into the real estate parts of this. But before we do, just to talk about your business a little bit and how you grew that, do you think that there's parallels between what you had to learn from a business acumen and a personal development standpoint to grow that business compared to real estate investing? You have to know how to maybe grow and manage a team. You have to maximize your hourly rate. You have to decide where your core competencies are. What's the 20% of your activities that drive 80% of the revenue? You might want to set up as much recurring revenue as you possibly can. Can you spend a minute and just kind of walk us through where you think those parallels are between entrepreneurship and real estate investing?
Yeah. And as an So as an investor myself, I invest in real estate as well. I'm a real estate focused CPA. There's a ton of parallels, and I would say it all chalks up back to the experience of just getting your hands dirty. So there are so many things that I've learned in the last 6 years in this business that I would not have known had I not failed at them, succeeded at others. There's so many cliche quotes out there about it, but it truly is just rolling your sleeves up and getting your hands dirty. So when I think about if it's us at TrueBooks trying to spin up a new service line or hire somebody new, it's no different than a real estate investor hiring a new contractor to deal with for the first time, putting together a spreadsheet and running the analysis of what the numbers are going to shake out for a deal, and then actually following up, doing the deal, and then running back to your projections and seeing how they mirrored back to the projections. So I think people do a lot of idea generating and they don't do enough doing, which is, again, I just feel like for saying because so many people talk about it, but it's true. And I have only ran a business for 6 years. I feel like a veteran at this point. I will say I feel like I know a little bit more than most 6 years in because my business is to deal with other businesses. So not only am I dealing with my own and growing my own, part of my business is to come in and help a business optimize their cash, optimize their accounting, save on money with their tax bill. With that comes with who are the people on your teams, what are the systems, what do you sell? But as far as the parallels back to real estate investing, 100% the same. You could find a lot of it, which is starting, doing, and then as you said, you have to start. I think not enough people do what they simply write down. Just as we were talking about before we started this, doing what you say. I think a lot of people would be better off if they just did what they sat down for an hour on Sunday and wrote down that they were going to do. If they just did that and then took 20 minutes to go back and evaluate how did this shake out compared to what I had written down, and people will be so much further ahead because in my head, you're spending the time anyways. So if you spend the time going back and evaluating, you're going to exponentially see the returns on that.
That is gold right there. That is some really good advice. And I believe that you launched this business in January of 2020. So this was 2 months before the world shut down.
Yeah.
How did that feel in that moment when it got to March? You've got this brand new business and your whole life is on the line.
So yeah, it was interesting too. I had my first son 2019 May. So I had a 7-month-year-old there at that time. My wife had a W-2 role still. So luckily we had some income there still. And like I said, I left with about 50 grand and then plus another 2,200 a month. So cash was top of mind. Luckily, the pandemic wasn't too much of a concern for me. Reason being, this business absolutely exploded still during that time because we're in a business where there was a lot of change going on. And with taxes, anytime there's a lot of change, there's a lot of confusion and people are running to their tax professionals. So I'm going to say good luck. That's another thing. I don't want to take credit where there's just pure luck. And I think it was pure luck that the market, I think, was doing really well when I think about like 2022 times. People were just printing, there's money floating everywhere in 2022. But 2020 for our business, we didn't really see a blip. I mean, just to kind of share what our gross revenues were of the firm, our first year we did 120,000. The second year we did 860. Third year we did 2.4. So it's like these numbers.
Are you kidding?
No,
oh my God.
We were in a time period where it's just like catching like lightning in a bottle too, where real estate was really picking up, a lot of investing, the forums were getting big. My partner was doing really well. So it was a market that we got into that was just very hot. So luckily, I mean, I wasn't slinging face masks because I know people that were making a couple $1,000,000 a month doing that. But
I remember that.
Yeah, luckily for our business, it was, dude, I had a guy that was selling face masks on Etsy that was making like $1 million a month.
You only need that to work for a few months and you're set for life. Right?
Exactly. So, but yeah, I mean, so for me, back to the pandemic, very scary as far as just life. We had a young son at that time, me and my wife. We were a new family or a young family, but luckily for our business, we really didn't see a hurt from it.
What did it take operationally to facilitate such unbelievable growth? Because I would imagine there's no way that you could have done all that by yourself. How many people did you have to hire? Did you know what order you had to go in order to grow with the insane demand that you guys had?
Yeah, we quickly probably got to 6 to 9 people, and I have all the org charts. I save them as time goes on and we hire new people, but I would guess 6 to 9 people or something within the first 18 to 24 months. And we learned a ton. We failed a ton. Failing meaning somebody signed on to pay us to do their tax planning and they maybe got lost in a process and didn't get an email or contacted from us for 2 months, 3 months, something like that. So there were a lot of goods and bads, but it was, again, shoving us through this point of time, which we got so much experience from that luckily now we know how to handle those situations better. We have things online, maybe there's a negative review or something on Bigger Pockets that I have to answer to. And it's like, I almost smile when I have to answer to those because those are good times for our business. As bad as they were, they helped us tremendously understand how to react in a situation like that so that if it does happen again, we know what to do and we have the playbook, but also just reflect and say, yeah, that was a sucky time. There was goods and bads. And so, but yeah, it was tough. Hey, really good experience though for us.
In 2024, you guys hit 105 on the Inc. 5000. How did that feel?
Yeah, that was huge. Yeah, that was a time where I try not to not focus on the good. And I don't want to say I'm like pessimistic in the sense of when there's a lot of good going on, I'm just going to find the bad. But I also think that when I even look at my own personality profile, when I first partnered with my partner in 2020, I was more of the integrator. He was the visionary. And now me taking those same tests on predictive index, I'm now more captain style and more driving. So it's very interesting selfishly for me to watch my own personality through that. But for Inc. 5000, that was a time where usually I don't kind of sit back and think like, oh, how good is that? How cool is that? And I think I got a chance to do that with Inc. That was cool.
Real estate is a team sport. You can grow so much faster if you're in the right room. The Launch REI Mastermind is a curated space for investors who want to move from hands-on execution to professional portfolio management. This is your personal board of directors. Inside, our conversations go beyond the tactics. We cover the decisions that actually change outcomes, structure, tax strategy, and capital allocation. If you want to build alongside a vetted peer network designed for the long term, apply for the Launch REI Mastermind at the link in the show notes. What kind of things do you think that other CPAs were commonly missing that you guys were able to identify to really drive a lot of savings for people, particularly real estate investors?
So there's a couple things. It's astronomical to me to see how many CPAs and accountants out there that just do not understand real estate taxation. They don't take it. And I don't say that in a way of, to me, there's level, I like to quantify everything. So from 0 to 10, You can get really good in real estate taxation. Like we could talk about a lot of cool stuff here that I'm sure you already know about, and like cost segregations and all that. That's like a 6, 7 out of 10. That's not even like an 8, 9 out of 10. 8, 9, 10 out of me is like the conservation easement stuff. It's capital allocations when you're talking about syndications and GP sponsors. So what's wild to me is how many accountants out there could service this market so much better if they just put in a little bit of effort. And so it's been very shocking to me to see that they didn't capitalize on that. So that is very niche specific, but again, I think it's a downfall to other accountants. And another thing is accountants are very bad at selling what they're worth. And what I mean by that is, here's a perfect example. I'm having dinner with my wife's uncle, who's been running a CPA firm for 40 years. It was his dad's firm. I'm going in to meet this guy. I'm thinking, man, he's big fish. I'm little fish. We were doing about, $3.5 million at the time in revenue. And I'm pumped to meet him, thinking he's probably doing 10 to 30. And after an hour of conversation, we're doing the same amount of revenue. He's netting a little bit more. But hearing about his business model is he doesn't charge for any planning. He only charges people to do their taxes. Hey, Vince, we're going to do your taxes. Your fee's $1,000. We're going to file this for you. But all the conversations where he's on the phone all day with these people talking about things, Jim writes in and Jim goes, hey, should I do this or that? And all these phone call conversations that he's having, he does not charge for. And so helping him understand how our business model is so different would easily add another like 800,000 to probably $1.5 million onto his practice of the same book of business. And so I find it funny that he was treating what we do as almost his loss leader, like doing tax work. He also is like, I'll give that away because I want their business management, and he does investment services. So he wants to manage their money as well. So he treated his entire tax and bookkeeping practice as like a loss leader, Costco chicken, versus I'm like, dude, our entire model here is to make 20 to 25 cents on the dollar. So I just think that it's a real mental shift of how they're billing clients and how they're structuring their service is what I've learned as a young practitioner coming up in this space.
As you look back on it, what do you think is the best decision or hire that you guys made in those early years that really, really drove that hockey stick type of curve upward?
Man, the best. So very interesting. We've had great hires and we still do have great hires, but my brain immediately thinks to that hockey stick curve, and what attributed to that was content. And so we were just kind of talking about what your plan is and what you're doing monthly is. And that was what I learned from my old partner so well. He did that the best, the marketing and the content. And so that is the reason that I think we had that hockey stick style curve up. Is I don't think it was an internal hire. I think the internal hire, TrueBooks has always been in a spot where we're hiring to fulfill what content has sold. And so, yes, we found ourselves in the last 2 years specifically prematurely hiring, getting ready for that growth so we don't make those same decisions of running too lean like we did early on. But that hockey stick growth was attributed to the content. So who did we hire? The contractors that help run the camera and help do the editing and help do the posting. Those were the ones that were most instrumental for us for sure.
That is really interesting because a lot of people that are listening to this, they might want to grow their social media presence, to grow their business or anything that they're working on. What advice would you give to people that want to grow their social media brand in terms of, hey, this is who you need on your team. This is, depending on what your budget is, who you might want to consider. What does that team and setup kind of look like?
My challenge to anybody, well, one, I hope that we're past the point of like, should I do this? I think that that's clear. If somebody is still really debating on that, then I would that's heavy concern for like, hey, you're not ready to do anything. You need to be a W-2 employee. If you are sold on the fact that we should be doing this and you move past that, I think that people just need to get out their phones and take raw videos of themselves doing stories on Instagram and whatever platform that they're using and worrying about doing the little edits themselves. I really do wholeheartedly believe in that. Outside of that, when you're ready to start spending any money on it, I then think it would be somebody to edit. So as we talked about a little bit too, is when you get in the long form content and you're doing YouTube videos or you're doing maybe longer short form videos, paying somebody to put a professional spin on that with some branding and things like that is the first person I would hire. The second person I would hire is somebody to post and manage the content. So if you look at my team, that's who we have now. We have somebody that posts and organizes all content. And then we have now somebody who kind of runs strategy for us and helps like develop the brand. And then we have people that are editing. So those are the three core components. And keep in mind, the person that is organizing my content is also doing the scripting for me, which with the tools nowadays, it gets so easy. So that's why I'm a fan of saving the dollars, investing those dollars into maybe paid ads or whatever it is there, and running the content on your own. Because I also think people are enjoying more of the raw content nowadays over the purely curated, perfectly edited content. They like that in real life kind of stuff.
And you guys have, I think, 40,000 on Instagram. What other platforms do you guys have or use? It sounds like you guys might be using YouTube. What does that look like? And how long did it take you to get to 40,000 on Instagram? Because that's pretty impressive, especially for something that's CPA focused. You would think maybe doesn't have that kind of crazy spark for demand like the sexy Airbnbs and things like that.
So, sorry. It was really 2 posts on Instagram that got me that following. One of them is pinned. It really is. It is. One of them had about 1.5 million views, and it was when the BOI came out. That one really popped off. But if you look at the post, that is like, it's me sitting there, no shirt, and I'm in like no shirt. It's me sitting there, no hat. I used to wear a hat a lot. I have a shirt on. I'm wearing a gray shirt, and it's me talking about the short-term rental loophole. That got me like 25,000 followers alone. That was huge for me. And what's crazy is I just reshared that and was like, this is still very relevant. It was related to short-term rentals. So I would, sorry, what was the question though? But I think it was really those two.
That's good.
What do we post in the platforms?
We're going to talk about those 2 things because people probably still want to know about those 2 things today. So let's talk about what those 2 things actually were, because the algorithm told you, hey, this is what people want to hear about. So what is, did I even say it right? Is the BOI? What is that? And then let's talk about the other one, which was about, I already forgot what it was, but you'll remember because it got you 25,000 followers. So what was the first one? Go ahead.
So the first one, which luckily is no longer applicable, but it was the BOI, the beneficial ownership interest. And this basically was the Fed trying to crack down on LLC creation and who actually owns these entities, because tax does get very messy when people go out and have all these ideas and set up all these entities and then not report them correctly. Luckily, that has gone away. So BOI is no longer a thing, but hey, I still got 1.5 million views on it, so it worked for me. Luckily, we capitalized a little bit. And then the next one is the short-term rental loophole, which that is, still one of the hottest strategies out. And I've been saying this now for, what is this, 4 years? 5, probably, I mean, since we started, so let's just say 6, is, and again, I'll kind of say it high level, however nuanced and sort of detailed you want to get into it, but it is, there are a lot of rules that disallow people using their investment real estate to offset their W-2 income, their spouse's business income. And so just to kind of preface, that's what our firm specializes in. We are real estate accountants to help utilize real estate to bring down people's taxes. And so specifically, as I mentioned, there's a lot of rules that avoid this, where I call it this net effect, is like the euphoric effect. So if I make $1 million and my real estate on paper loses 400,000, I'd like to net those together and pay tax on 600,000. And short-term rentals have kind of opened up this side door, this trap door to go through and allow people to do that. And so we have a lot of high-tech W-2 investors that are doing it, high-income business owners, doctors, dentists, lawyers, things like that, that they're utilizing this strategy to do that. And so I'm happy to get into details there and specify, but yeah, that's essentially the strategy.
Yeah, let's dive into it. So what's a really common case? What type of job might somebody have? And if they go through with this and they buy a short-term rental and they want to utilize that loophole, how much can they actually save? And are there any downsides on the back end or long-term that they have to know about? Or is it just free money, basically?
So let's walk through this. Ideal avatar, one of the most recent ones that I've dealt with internally at my firm. Meta W-2 earner making about $2 million between RSUs and W-2 comp. Okay. They're going to go out, they're going to buy a property in the Smokies. They specifically are looking at deals that are like $600,000 to $700,000. So how this works is, if we take I'm going to pull up a calculator here quickly. I thought I have one on my desk. No. So if we pull up a calculator, this is sort of the rough math. If we buy a $700,000 house, and first thing is we need to depreciate part of it, right? That is, depreciation is writing off a piece of what you purchased. And so what bonus depreciation is, for any investor here, or anybody here that is a little new to that term, is you're accelerating, instead of writing off it over all of these years, you're accelerating part of it to the first year. So if I take a $700,000 house and let's just say 20% of this property that I bought, 20% of it is the land. So if we take 700,000 times 0.8, this is my building basis, okay? So I'm left with $560,000 in cost. If I have a rental property, you would know this, usually in year one, my NOI is usually about zero. So if I'm looking at a profit and loss statement for my rental property for the first year, income, expenses, net income, probably going to shake out about even for the first year, unless you have a crazy cash flowing deal or you even lost a couple bucks because you had to furnish it, whatever the case is. So assuming net operating income is zero, when you're looking at a profit and loss, the one number that we do not have to arrive at this taxable loss is we need to add in depreciation. That's an expense that you get to take as an investor. So really quick, if I'm left with $560,000, if it's a short-term rental, we have to depreciate those over 39 years. So if I took 560 divided by 39, a normal accountant, I would get like $14,000 in depreciation a year. And I would just get $14,000 for the next 39 years.
I thought it was 29. Is 39? Is that correct?
27 and a half if you're residential, 39 if you're commercial or short-term.
Short-term gets classified under that commercial category where, what?
Yep. So, all right.
I did not know that.
So let's back up. So let's go back to the 560. We're not a normal accountant. So we're going to our whole goal is to maximize tax savings on this first deal. So we take 560,000, okay? And instead of divided by 39, this is where you would go get a cost segregation study. And let me explain quickly what that is. What I just did was I assumed I bought that for 7 and I said 20% is land, 20% is building. Well, you can't classify all of the building as just building. Some of the assets within that building can be depreciated faster or slower. So the structural part of that building is 39 years, but the furniture, the fixtures, the carpentry, the cabinetry, the lights, all of that and the interior assets can be depreciated faster in year one. Those have lives of like 5, 7, 15 years. But again, anything with a life of 20 or less can be bonused in year one. So we're trying to now assign what those values are. This is where, as I think a good, reasonable accountant, at a $560,000 building basis, I'm going to say at least 25% would be the benchmark. Can it be 40% of the building basis? Yes. Can it be 10? Yes. But you see, just for conservative values, we're going to use 560 times 25%. So we're looking at 140,000 of assets in that building you just bought that can be depreciated in year one. Not to mention, remember, we were at 560. We're going to take 140 immediately. The remaining 420 can be depreciated over 39 years still. So you're going to get a little bit more than 140. The part that I want to highlight here is now think about this. If I have a $100,000 W-2, okay, and I just went out and saved up money and bought this property in the Smokies, and my NOI was zero, and then I hit it with this $140,000 depreciation expense, you're looking at a taxable loss on paper of $140,000. And this is where if I have somebody making a $100,000 W-2 that's at Meta or they're a nurse and I lose 140 on paper, you're talking about completely offsetting that person's income with no tax bill.
Wow.
So that's like the pause there is like, that's what our firm specializes in. How do we utilize the real estate to offset the tax bill? Now you would ask, well, like, are there any cons to this on the back end? Potentially, if this person was going to sell the deal a year or two later, it might not make sense because all of that depreciation that you just took, yes, may potentially have to be recaptured and sort of added back as income. I don't want to say paid back because that's not how it really works, but it's added back as income. Think about it. The government gave you this huge expense. Now you're going to have to pick some of it up as income later. So there's a timing effect that comes into this. But overall, in the grand scheme of things, if one, you're a real estate investor, you would be silly not to find out how this applies to you. But two, it's like, how do you draw people into the real estate space? Well, show me another investment where you're going to ideally buy something that cash flows, increases in value, and at the same time is going to help me with such an ROI on my tax bill. It's kind of unheard of.
Let's talk about the people are probably wondering about the recapture. I'm wondering about it too, because you've got to think with something this incredible, it's going to attract hundreds of thousands of people that want a bite of the apple, but there's no such thing as a free lunch, right? So there's got to be some downside here. What is recapture? How does it work? When does that come into play? Because people are probably thinking that they're just going to save $50,000 on this year's tax bill, and then are they just kicking it down? Are they kicking the can down the road?
So it's funny that you use that term. We joke about that in tax because usually with life, you don't want to kick your problems down the road for the next year, but tax, we're all about doing that. Tax, sometimes the strategy is to defer. So the way that recapture works is like this. So let's just take this property. We bought it for $7,000 and we got a $140,000 deduction in year one. Okay. So now we're sitting with an adjusted basis or a net book value of $560,000. This is where people go wrong. If this person bought this property for $7,000, did the whole cost seg, took the loss, they got the tax benefit, yada, yada. And let's just say year 2, they're going to sell this property for $750,000. They would probably tell you, hey, I only made a gain of $50,000, right? Because I bought for $7,000, sold for $750,000. When in reality, your gain calculation is your sale price minus your net book value, that right, which has the adjusted basis in it for what you took as depreciation. So you could think of it as, instead of a gain of being 50, it's really 750 minus 560, which is 190. So this is where it's a timing difference. The government gave you this huge deduction up front that you got tax savings for, so later on you could be stuck with income. This is where, okay, is there any way around that? If you wanted to just flat out sell it, you're going to end up having to pay some recapture. But there's ways to avoid it and kick that down the road. 1031 exchange. You could buy another piece of property that could help offset the gain that this one is driving. So there's other ways to navigate around it. But if you just flat out sold it, it's the same thing with cars. I use this example a lot with cars. You buy an $80,000 Range Rover. You depreciate all of it. You write it all off in year 1. That's one of the best tax strategies out there. Buy a car. You then sell it the next year for $50,000. So you're like, great, I lost $30,000. Bought for 80, sold for 50, I lost 30. No, you bought it for 80, you depreciated the whole thing. So your net book value is 0. You sold for 50, 50 minus 0 is 50. So you'd have a $50,000 gain. So these gains do come into play and you have to tax plan around them. So it's a temporary expense is what we would call it in tax.
This episode is brought to you by Easy Street Capital, the lender built by investors for investors. Whether you're flipping, building a rental portfolio, or executing a ground-up construction project, Easy Street has 3 nationwide loan programs designed to close fast with no surprises. We're talking 24-hour closings, upfront terms, and in-house servicing from start to finish. If you're ready to fund your next deal, go to easystreetcap.com/launch REI to get started, or you can grab the link in the show notes. Matt, I have so many questions. At what income level does it make sense for someone to buy a Range Rover just for the tax benefits?
So I am an accountant that takes a stark approach on do not spend money for the deduction, because that's why I really amps me up. Like if a client ever called me and was like, why don't you tell me to spend money here? I'd probably fire them because I'm like, that's not good accounting advice. Your accountant shouldn't be calling you, telling you to spend money on things. What they should be calling you and telling you is, hey, you're going to be left with this much income. Here's the tax on it. Because the real answer is, if the answer is to deploy on assets like a vehicle, assets within your business, labor, whatever it is, then that might be the answer. But when does somebody make enough money? So see, this is to me a personal finance question. And as somebody who tries to stay pretty risk adverse, I watch my overhead very closely. I don't want to be one of these internet pop-ups making money and then falling off the grid of the map. Would be when you're making $250, I think you should buy a new car. Because at that point, I think at least $250,000 before you buy something new. And I'm talking as a household. So sure, husband, wife, they're working. One of them's making 2, one of them's, whatever. Because even then I'm not a huge fan of a new car. But as far as the deduction goes, hey, we work with a lot of real estate investors. You're a wholesaler. And let's just say you're a flipper. You're a flipper. You have a really old beat up truck. You had a really good year in profitability. We have a good angle at deducting the entire truck. You're talking about going out and buying a $90,000 car that ultimately could run you $60,000 because you had a really good year and you get to write off the whole thing. So, because remember, if I save you $100,000 in expenses and you're at a 30% tax rate, that's a $30,000 cold hard tax savings that you have. So that's another thing I don't think a lot of investors are terrible at it. Business owners get a little bit better in understanding that when you go out and buy something, you almost get a built-in discount because it is deductible. So
what do you think is the biggest misconception that people have about the STR tax loophole?
Here it is. This is the biggest. People think they can buy it, run it as a short-term rental, and hire a manager. You cannot do that. It throws the entire strategy off. If you buy it, you list it, you furnish it, you get your tenants in there. The average rental period needs to be less than 7 days. That's a huge sticking point there. And then they just kick it off to a property manager and don't spend enough time in it. That's a huge problem.
And if they don't do it right, you could end up with trouble with the IRS, or it could cost you $50,000, $100,000.
It's going to cost them. Yep. So you're not going to be in hot water with the IRS. You're going to be really mad that you didn't get the tax benefit from the deal that you probably bought the deal for. And this is where people should not buy the deal for simply the tax benefits, right? You hear the saying, don't let the tax tail wag the dog.
They do, though. They do it.
They do, which isn't bad, because I'd also say you should be, as an investor, factoring in what your after-tax ROI is and what the cash on cash is, what the return on equity is, and all of it. But tax needs to be a cherry on top, not the main driver. And we all know this. In real estate, you make your money on the buy. So you should be running every analysis that you can, included with a tax analysis too. But again, don't let it be the main differentiating factor.
How do you look at the tax implications of the different asset classes in real estate? Are you having different conversations with investors based on them having single family rentals, the traditional way, short-term rentals, if they have multifamily, self-storage, mobile home parks, there's industrial, there's these different asset classes here. Do these conversations change based on what type of real estate someone's investing in?
I'm trying to see if I notice like any major. No. The conversations change when the dynamic of the deal is partnership related versus solo investor, right? Because the asset classes, right, there's only so many of them. You really, for us, mainly commercial and single family, right? Obviously multifamily on like the apartment side, condos, things like that. But it is... No, the conversations are, what are the taxable loss? What's the cash in the deal? Should I 1031? So a lot of projection work around their own portfolios, but the conversation is much more educational and nuanced when we get into partnership agreements, because at that point, like we have these two guys here that'll, they'll go out, they'll buy a $10 million building and they'll raise money from 20 different people in this LPGP structure, which is, right, sounds like you're familiar to. You're in one of them. I'm in one of them. With those kind of deals, it's coming on and talking to their potential investors, explaining to them, hey, this is how your investment is going to be treated. Just so, because where syndicators go wrong is they go to these people, they preach to them, they're going to get these great tax benefits. And then when they get that K1 at the end of the year, they can't use that K1 the way that they think they can. And then they get mad at the GPs, and the GPs are like, what? I thought that it worked this way. And you're like, no, you're not an accountant. It does not work that way. So not so much asset class, but the dynamic of the deal is what really keeps us on our toes.
So let's say that someone has $1 million in real estate. They're making $200K a year in W-2 income. And there's this hierarchy of what they have to choose from or prioritize: cost segregation, depreciation, bonus depreciation. Could you just kind of touch on what those are and how they should think about prioritizing those options?
So luckily, all three that you just mentioned are going to be in the same category, in the sense of when you buy a rental property, you're going to get some of the depreciation, which is, if an accountant is really bad, let's say you buy a $500,000 house and they just go divided by 27 and a half, that'd be $18,000 a year. Why that is bad? They didn't factor in land. You have to remove land. Land is not depreciable. That's like our internal joke as an accountant. If you catch an accountant depreciating land, you kind of laugh at them. So, but then the factor would be, okay, so if I go 500,000, let's just say 10% is land, so we're left with 450. If I just take that divided by 27 and a half, I'm getting $16,000. So the question is, when do we factor in whether we should do bonus depreciation or straight line? I would say you have to evaluate two things. what is my net income from what the rental is going to produce? Because maybe it's it's so profitable, it's cash cowing, and I need an extra expense to offset the cash flow. Because our first goal is to offset the cash flow that the properties are kicking off and not have you be taxed on it. The second goal is to get this net effect. Remember, it's very hard to get your real estate losses to offset W-2 income. Those are in completely different buckets. So if an investor has a ton of cash flow and we need the bonus depreciation to help offset the cash flow on the real estate, it's the first thing we're going to visit. If the investor has already offset their cash flow, now we have a chance at cost segging and getting a huge loss over here, and we have an angle at offsetting their W-2 income, that's when bonus becomes a conversation. So it's not even so much of an income. We have people that are making 60, 70, 80 grand that have a couple rentals that we'll still be making that analysis on. Because the question is, can I use the real estate to offset my other income?
Got it. Okay. That is super interesting and really valuable for people. So thank you for sharing that. When do you think is the right time for people to find a CPA that specializes in real estate? Because a lot of people might have one rental property and they might think that they need a CPA who has a lot of real estate specialization. How would you kind of guide people in that way?
So anytime I'm asked the question of when, as a CPA, when should I hire a CPA? My two answers are this. As soon as you have a piece of rental real estate is one of them. Even if it's quick though, that doesn't mean that you need to engage with them and pay them $5,000 a year to do stuff. You need to pay somebody one time to learn what you need and then go off, maybe do your own tax return on TurboTax or something like that. But the other one is, so if it's not rental real estate or real estate of some form of investment, it's running a business. Because when you're an investor or a business owner, the tax landscape completely flips on its head for you. You have opened doors to so many new things that you did not have as a W-2 earner that's when it's my opinion that you need somebody to help navigate it.
And you yourself, I believe you have 3 properties personally, and most CPAs don't invest in real estate. Why do you invest in real estate? And do you feel... Sorry, I'm just waiting for a car to go by. We'll edit that part out. It was so loud. You have 3 properties personally, and most CPAs don't invest in real estate. Do you feel like that helps you or gives you some skin in the game when you're giving tax advice to your clients who are real estate investors?
It does. And not only my own experience, but the other clients that we have with bigger, just as you said, right, huge portfolios that, it's not me running them, but I get that experience through seeing theirs and seeing the numbers and dealing with the same challenges they are and talking them through it. But sorry, what was the question though?
Oh, no, it's okay. With the three rental properties that you have, do you feel like that kind of gives you skin in the game? Does it give you more perspective because you're giving tax advice on the situations that you're actually facing yourself many times, or you actually might see some investors who are clients that show you your next move, because that's a little bit of what happened earlier in your story where you were working in bookkeeping where someone was flipping at a high level. You start seeing all this real estate activity and you go, oh, this is kind of interesting. Real estate obviously, looks like a pretty attractive place for you to be. And you're going to see all the numbers, right? You're doing their bookkeeping, so you know everything. Yeah. You might see some of your clients who are doing self-storage or investing as an LP in mobile home parks, or people that are on the GP side of this type of real estate investing. And you might see what they're doing on the actively earned income side or partnerships, or even investing as an LP and say, hey, I think I want to put some of my money where they are. You might want to copy some of your own clients.
Yep, exactly. And so, yes, that is something that I'm glad that I like to invest in real estate. And I think that was part of the question too, was to why that asset class. I think I trust it more than the stock market. I love to see certain clients that I have, and the cash flow that their portfolios produce is just absolutely insane. So I like the asset class as far as investment goes. I plan to retire as far as investing into real estate. I obviously run a firm, so this is my first main priority. But investment is a long-term goal of mine. And then, just as you said, it is nice to see what other people are doing, because then, hey, even though I'm their accountant, it can kind of, as you said, tip me off as to maybe what I want to do next. But yeah, no, I think it has helped me for sure, because I deal with the same things and I know what they're going to need now as a professional, but also an investor.
What is one tax move that you think that everybody should know who's listening, that they should consider doing before the end of the year, that is just really important, that most people are probably just not paying attention to? So
no matter what kind of tax talk I do, I leave with this same note. and it is do your account. And so luckily in your question, it's still going to stay relevant. Do the accounting within the year, because there's two things. So many people think tax planning is sexy and you can save a lot of money doing it, which it is. It's great. But there are so many more people who can't benefit from tax planning because they don't have anything put together. And so my one recommendation always, no matter how complex or easy the tax talk is try to get your accounting buttoned up at a minimum every month so that you can, one, not only understand what your investment, if it's a rental property or a business, is producing, and you can understand and see it now. But two, help you understand what tax moves that you need to make. Because as you said, maybe it does make sense for you to go out and buy something, which does have to happen before the year ends. But if you don't have your numbers in order, you don't have the information to do that. So the number one strategy that I think people miss out on is good accounting is what they miss out on, which is they have bad accounting. They do it late, they miss deductions. And so I think people would be a lot better off and further along than they think if they just did that starting out.
How much money do you think people are leaving on the table because they don't have the proper tax strategy in place, or maybe they're working with a CPA that's not optimizing their situation?
I think 5 to 20% of your tax bill on average, just from people. And I'm talking about a business owner or investor. And honestly, a business owner, I'd probably span that to 30 points. So 5 to 20 cents on the dollar conservatively. I think if people got smarter with their tax strategy, they would be saving. So if you paid $100,000 in tax, I think you could have got that down to 80 grand or so.
Wow. Think about the
without
difference
too many
that
major changes. Yeah.
That's incredible. That's just amazing. What's next for you? Where do you see this business going? And where do you also see maybe your own personal portfolio going in the next few years?
So I personally want to own a storage unit. I want to own the storage unit right next to my house because I love that building. I'm a customer of that storage unit. I love it so much. So I personally would like to buy more single family, and storage is my own investment choice. But my main priority is this business. I'd like to get this business we were just short of $4 million last year. And we've been stuck in this $3 million range now for 3 years. So it's proved to be pretty tough to get out as a small business. I would like to get to $10 million, which is probably 80 employees or so, 60 to 80 employees, and then look up from there and see what's going on. I really think that I would like to start acquiring other CPA firms eventually, but I have a big ego in the sense of I want to make sure mine is working well before I start buying others. I don't want to get
that is so interesting.
Yeah.
What would you say to someone out there if they recently started their own CPA firm? They're kind of new. They maybe are just trying to get things off the ground.
Two things. Don't ever stop thinking about client acquisition. I think accountants get really lazy at thinking that once they landed a client, it's great and they're there forever, which is also great, because that's another reason that I love this business, is because if I do a good job and Vince, you're a client, you should be a client for 20 years, and then your kids should be clients. Which is also what turns into my next piece is keep the business. Like we have this saying here, get the business, keep the business. Not enough people focus on that client journey and that client interaction and the client experience. And so for us, those are what's in the sights. And for us now, revenue is more of a TrueBooks problem. Hence why when we were talking, I'm like, hey, would love to advertise, would love to sponsor anything, because that is our main line of focus now. But at the same time, we have other people and a huge focus on client experience, because that's the beauty of this business. If I do a good job, we should retain somebody for a lot of years and have such a low churn. But only if you do a good job, right? It costs to land the client, it costs to bring them on, it costs to service the client. So when you lose them, it hurts.
That is incredibly valuable wisdom that's just going to be relevant for so many people. So thank you for sharing that, and all the things that we touched on for people in different situations, the STR tax loophole, things that are so commonly asked about. And it's just really, really valuable and hard to get information that not everyone has access to. So we really appreciate your time being here today. And where can people learn more about you, the tax services that you offer for investors and business owners, and where can people find your stuff?
So Instagram's probably the best for, I drop tax tips and things like that and what's latest and greatest in the news. That's just my first name, last name, at Matt Bontrager on Instagram. I got a YouTube channel as well.
That last name, just in case people have a hard time hearing it?
Yeah. Bontrager. Trager, Matt Bontrager. And then I got a YouTube channel as well where I try to do some of the long form content, which same thing, just my name. And then our website, truebookscpa.com. Funny story, I tried to get truebooks.com, but Kelly Blue Book owns it and they want $1 million.
Oh my gosh. Wow. That's crazy.
So
I think that you'll do okay without it.
Yeah, I think we're going to be fine with that. I think that'd be a bad use of capital to spend $1 million on a domain. But anyways, yeah, those are the ways. So,
especially when you could buy 11 Range Rovers instead.
Yeah,
and then write them off and get the bonus depreciation. But I'm not a CPA, so don't listen to me.
Exactly. Yeah.
Thank you so much. We appreciate you being here, and we'll be excited to have you back in the future, especially as the tax landscape evolves. So thank you so much.
Yeah, thanks, Vince. Appreciate it.
If today's episode was useful, subscribe so you don't miss what's coming. We drop 2 episodes every week. And if you want to go deeper, join thousands of investors getting our free weekly newsletter at newsletter.launchrei.co or check the link in the show notes. See you next time.